Good day, my name is Dean Crocker. I'm a Senior Equity Analyst with the PSG Wealth Research Team, and today I'll be taking through our latest EIA completed on Remgro. So just a few key points I'd like to leave with you post the presentation are we have seen a narrowing in the gap, which is effectively just a reducing in the discount relative to the intrinsic net asset value, and this is largely due to the proposed unbundling of RMI's shareholding in its listed investments. As such, the intrinsic value that we have calculated sits at R142.60, implying only about a 5% upside at the current share price. It is worth noting, however, that Remgro is a nice proxy to the market, and as such, should potentially always trade at a discount due to the fact that it's a holding company and has debt and a large component of unlisted investments, and as such will always continue to trade within that discount to the market. It is trading at a price to intrinsic net asset value per share of 76.6% or 23.4% discount. In terms of the key charts, the next chart will show the price to discount relative to intrinsic net asset value over the period of time. We are seeing that discount narrowing, and that's largely due to the RMI bundling. We have seen an improved balance sheet. They have sold a couple of their first round shares, which they've used to reduce their debt burden on a holding company structure. Then there's a final key table that we'd like to go through, which is effectively just the calculation of the intrinsic value. We do base our recommendation on that, which we feel is fairly valued at current levels. It has seen quite a sharp increase in the movement of the share price following the proposed unbundling, and as such, the discount that it's currently trading at is below that of its 5-year average. It does still have potential to move to its 10-year average, however, we see that has been less likely. So just in terms of the one table that I want to reflect, this is just the Remgro trading as 5-year average. Below its 5-year average of 34%, there's a discount of 23.4%, and that was just at date of release. As you can see from the graph, since roughly about 2015, 2016, when the group started incurring additional debt on a holding company level, and their unlisted assets started to grow quite substantially, the group has traded at a discount to its intrinsic net asset value. In terms of just how we calculated the average intrinsic value, we can calculate an average value of 142.70, and this is really based on the fact that we took 4 scenarios. 2 bull case scenarios, a base and a bear. And the bull case scenario, bull case 1 was just if we had to revert back to the 10-year average, and the slight discount to the 10-year average was 19%. Alternatively, bull 2 was just assuming that there is no discount, that the company trades at exactly what its intrinsic net asset value is. We do see that being relatively unlikely given those unlisted investments as well as the debt and holding company. The base case, we have assumed that the latest RMI closure in terms of their discounting has filtered through to the discount at which our Remgro would trade. That's now 31%, and the bear case just assuming that the highest discount. Based on that, we receive a weighting of 142.70. We have weighted towards the bull side of roughly about 40%. However, being that bull case scenario 2 receives a very small weighting relative to bull case scenario 1. With regards to the event, so as I mentioned, is the full year 21 results. The income statement is largely interesting but really irrelevant. We did see a nice improvement in the headline earnings of 65.9%, but that's largely coming off a low base following COVID. The likes of Mediclinic are still not recovered significantly. We did see a sharp improvement in Distel as well as RCL Foods. So the intrinsic net asset value at which they reported had grown by 14.8% to 177.33. Now it is worth noting that there is a discount to apply to that to get to where the share price is right now. Material investments during the period, they increased their stake in RCL Foods to 80.4%, KTH up to 43%, and CIVH undertook 2, if I recall correctly, 2 rights issues which increased their shareholding up to 55.5%. We haven't seen any further details around the Heineken Envy offer to acquire Distel from Remgro. However, Heineken did request that Distel does not pay out any dividends during this time, so it does seem like there are still talks ongoing. Then the final component of the event was really just the RMI unbundling. That has been seen very favorably by the market. It resulted in a nice closure of that gap, as we mentioned, and it has seen that there will be a benefit to Remgro as they will not have a double discount. The total dividend per share was still down 66% at 90 cents, but that is really largely due to the fact that their accounting treatment of first round has changed, and they have reduced a couple of their real high dividend paying counters. With regards to the impact on data release, the share price closed 2.99% higher. This beat the all share at the same time. Since the beginning of the year, Remgro has, however, outperformed the benchmark. They have closed that discount quite sharply, largely due to RMI's unbundling, with the price to intrinsic value discount of roughly about 23.4% relative to its 5-year average of 34%. Based on this, the group does seem fairly valued relative to historical averages and its peers. It is just worth noting that it is a very nice proxy to hold for the market. But yes, that's how we see it at the present. With regards to the assessment, we have seen that narrowing in the discount, as I've mentioned a few times. We are still concerned about the continuation and the support of the CIVH investment. They have spent a considerable amount of money there, and we feel that they could have allocated it elsewhere for better return on invested capital. Within that company, the likes of DFA and Vumatel has been profitable on an EBITDA level, whilst DFA is still loss-making. Underlying investments, they continue to offer very great sector diversification. They're high-quality assets. We do not feel that there's much risk in the composition of the asset base, just more in terms of servicing their debt, which sits on a group level. Based on that, we have obtained our intrinsic value through the table, as I shared earlier, of 142.60, and feel that the share is currently fairly valued. Should you wish to place a trade, please speak to your financial advisor. Alternatively, the trading desk would be more than happy to assist. Please take note of the disclaimer and have a good day.